네, 시청자 여러분 안녕하세요. 한경글로벌마켓 김종학 뉴욕 특파원입니다. 오늘은 기술주 분석의 대가로 불리는 댄 나일스 인베스트먼트 그리고 사토리 펀드 창업자로 유명한 이분을 모셨습니다. 최근의 시장 상황이 경기 침체에 대한 공포 그리고 특히나 엔비디아의 실적 이후에 갈팡질팡하는 흐름들이 이어지고 있습니다. 댄 나일스가 분석한 엔비디아의 미래는 어떻게 되는지, 반도체주와 기술주 이렇게 중요한 종목들은 어떻게 투자해야 되는지 오늘 인터뷰를 통해서 인사이트를 얻어보도록 하겠습니다. As we head into September, we've seen increased volatility with the S&P 500, and especially large tech stocks showing some weakness. Do you think this is just season dip, or could it be signaling a bigger shock ahead?
Well, I think right now you're at this interesting point. Investors are happy that growth has slowed a bit, therefore inflation has slowed, and so then the Federal Reserve can cut rates. The thing that investors are scared about, which is why you have this increased volatility, is if it slows too much, they worry that we will go into a recession. I don't think that's going to be the case, but that's why you have this increased volatility, which is they want things to slow, but not slow too much. When I came into the year, I thought the S&P could be up 20% this year if we had solid growth, no recession, and the AI trade sort of continued. And that's what you've seen. So I think it really comes down to whether you get a recession or not, because you're definitely getting Fed rate cuts. And if you think about a recession, it's hard to imagine you get one in the United States with 10% more job openings than people unemployed. You've got unemployment still low at close to 4%, around 4.3. And you've got GDP still growing at 3%, and you'll have the Fed cutting rates by probably 3 or 4 times before the end of the year. So given all of that, it's hard to imagine you get a recession, which is why I think the market could still be up at 20% or so this year. But I do think it's not going to be driven as much by technology stocks as by other companies that benefit from the Fed cutting rates, such as consumer staples or utilities or telecom services. And so I think what you've seen already, which is tech stocks struggling, but other sectors of the market doing well, I think that's what you're going to continue to see through year end.
After Jerome Powell's speech at Jackson Hole last month, a rate cut seems almost certain. The big question now is about the scale of the cut. There's been a lot of talk about whether it will be 25 basis point cut or 50 basis point cut. What are your thoughts?
Well, I think the initial cut will only be 25 basis points. It's hard to imagine it's 50 to start with, but I think there's a good chance that at one of the next 3 meetings, because there's 3 Fed meetings that are scheduled between now and year end, I think there's a good chance you could get 50 basis points at one of those meetings, but I don't think it'll be on this first one coming up.
Historically, the inversion of the US yield curve has been a reliable indicator of a recession. Some analysts suggest that this inversion could lead to a market shock after rate cut. What is your perspective on the economy and stock market?
Well, it's interesting you bring that up, because if you look at it this morning, the 2-year yield actually went slightly below the 10-year yield for the first time in a long time. We're in an unusual period. We've never had a global pandemic in the modern stock market age. And so the response of all this money flooding into the market, all the buying of bonds that you've had by central banks around the globe, all of this has really distorted what the yield curve is doing. And so I don't think that's the best thing to look at. As I said before, I think the labor market, the strength of GDP, where unemployment is, the fact that the Fed does have room to cut, because inflation is in that 2 to 3% range, but the Fed funds rate is at 5.25 to 5.5. So if you believe that Fed funds rate should be somewhat closer to where inflation is, That leaves a couple of percent that the Fed could cut rates by to get things back closer to neutral in terms of policy versus restrictive, which is where a lot of people believe it is today.
Thank you. Now let's shift our focus to tech stocks. Tesla and NVIDIA are the two top holdings for many Korean investors, and we've seen significant inflows into leveraged NVIDIA ETFs recently. However, the market seems to be moving into the opposite direction. Why do you think NVIDIA stock is declining despite its strong earnings last quarter?
Well, number one, the earnings weren't that strong last quarter. You had revenues and EPS beat by only 4 to 5%. If you go back a year ago, they were beating revenues by over 20% and EPS by over 30%. The second thing is gross margins declined last quarter. They're expected to decline in the October quarter, and they're expected to decline again in the January quarter. And with semiconductor companies, typically the direction of gross margins is important in terms of the direction of stock price. But the most important thing is the fact that we've written about this and posted about this back on July 11th, I think. We think we're close to a period where the companies are going to have to digest all of this money that they have spent on AI infrastructure. If you think about it, NVIDIA's revenues before ChatGPT was introduced at the end of 2022 through this most recent quarter that they reported, revenues are up about 5 times from those levels 7 quarters ago. But the problem is, if you look at the big companies that are responsible for a majority of that spend on AI infrastructure, Microsoft missed their Azure numbers, which is where the spending from OpenAI goes through. Their forward numbers at Microsoft came down. Amazon forward numbers came down after they reported the June quarter as well. Google's forward revenue numbers came down after they reported the quarter also. NVIDIA's revenues are up 5 times over the last 7 quarters. You're probably going to go through a digestion phase. And what I would say is that don't forget, this happened not that long ago, where during COVID, NVIDIA's revenues in early 2022 peaked at up over 84% year over year. By the end of 2022, their revenues were down 21% year over year because Microsoft, Amazon, Google all were digesting the amount of money they spent during COVID as revenues slowed down for all of those companies. And NVIDIA's stock during that period of time went down 66%. Even though I am bullish on AI infrastructure spend over the next several years, and I do think NVIDIA's revenues are likely to double again, and the stock will double again, I think in the near term, you have to be very concerned that there's going to be another digestion phase, much like you saw after COVID, that's going to occur.
If NVIDIA is likely to remain flat for a while, should investors consider taking it off their radar?
No, you should always have a great company on your radar. It's just you have to realize that it's not going to be straight up and to the right. You're not going to have revenue growing every single quarter. You're going to have some very sharp corrections along the way. Even if you think about the build out of the internet back in the mid-90s, Cisco, which became the most valuable company in the world at one point, that stock went down 38% from peak to trough in 1997. It went down 37% from peak to trough in 1998. That's despite the fact that their revenues grew every single quarter because revenue growth did slow down during different periods of time, and there were economic concerns during different periods of time. The stock ultimately, Cisco stock went up 4,000% from the end of 1994 to its peak. And Cisco's revenues went up 15.5 times from the end of 1994, which is when Netscape Navigator was introduced, the first internet mask browser, to its ultimate peak. But it did not mean that you didn't have some pretty sharp corrections along the way. And this build out of AI infrastructure is happening at a much faster rate than the internet infrastructure build out occurred. And so that's something you need to think about. I do think you could have NVIDIA's revenues decline sequentially, and therefore the stock could get hit very sharply if that does occur.
Google CEO has remarked that the risk of underinvestment in AI is greater than the risk of overinvestment. While this could be positive for NVIDIA, it's also big challenges for Google, Microsoft, Amazon, and others. Do you think we can still expect strong performance from these companies in the second half of this year or next year?
Well, I think each one's a little different. I mean, I think the first thing is the fact that these companies are all saying that the risk is underspending, not overspending, tells you that they're probably overspending right now, and they all know it, which means that any slowdown is likely to be sharper than what people are expecting. I think the second thing is for each one of them, they all have different issues. For Google, there's a lot of money being spent on AI infrastructure, and there's a lot of good AI companies out there. So you have to ask yourself, can they maintain over 90% market share in search, especially when you also have at the same time the antitrust trial going on, which probably means in a couple of years, they won't be able to pay to be the default search engine for things like Apple's iPhones or be the default search engine for Chrome operating systems on Android phones. So I think that's Google's issue. And if you remember last quarter, they also had problems where YouTube revenues came in less than expected. For Microsoft, even though they have this relationship with OpenAI, and OpenAI is being hosted on Azure servers, Microsoft missed their Azure numbers during the quarter. And I think part of it is because OpenAI does have so much competition that some of their revenue growth is slowing down as some of these other companies take share, specifically when you have a great AI model in Llama from Meta, which is for the open source community. So that's free. So I think you have what these companies can charge, like an OpenAI, coming down quite dramatically when you have a great product from the open source community, specifically Meta, coming out. And then, of course, you have Anthropic, you've got Perplexity, you've got Microsoft, which is having Bing powered by ChatGPT. You have all of these things that are likely to eat into Google's market share. And in Amazon's case, even though their AWS business was fine and did well, the issue there is their e-commerce business came in below plan, which most people weren't expecting. And the margins were also less than expected. And so they have to balance how much they're spending across all of that. And so that's something to think about as well with them. So that's how I think about Microsoft, Amazon, and Google, and the challenges that they each potentially have. I mean, Microsoft could benefit. You do end up with a big upgrade cycle for PCs as people try to put AI capabilities into it. But I don't see that as a huge driver, quite honestly. For Microsoft, I see an upgrade of smartphones so that people have AI capabilities of that as much more likely, which is why I like Apple.
You previously pointed out that Meta and Apple seem more promising than the other Magnificent Seven companies. Considering current market trends and advance in AI, what specific strategies or market positions make these two stand out right now?
Well, I think for Apple, their AI features for the smartphone called Apple Intelligence, you can only run it if you have an iPhone 15 Pro or later. Less than 10% of the installed base of iPhones, which is about 1.2 billion iPhones, are iPhone 15 Pro or better. So that means that you're probably going to have a very strong upgrade cycle as people who bought new phones during COVID, which was back in 2020. I'd really like to have these features in a device that I have with me all the time, and that device is your smartphone. That's going to drive a big upgrade cycle for Apple, where if you look back over these last 3 years, 2 years ago, their revenue growth was only 2%. Last year, their revenue growth for Apple was they didn't grow at all. It was 0%. And then this year, it's only 4%. I think next calendar year, that revenue growth is likely to be closer to 10% because you are going to get people saying, I want to have these AI features on my phone, and so they're going to have to upgrade. I think with Meta is actually using AI the best in their business. where Meta is using AI to help recommend what videos they think you're going to want to see. And then they're putting ads on those videos that they think you will be interested in. And so Meta was able to beat revenues and beat EPS in the June quarter that they reported, but also have revenues and EPS go up for future quarters, despite spending more on AI CapEx, which is very different than Microsoft, Google, or Amazon, where all three of those companies, the revenue forecasts for the future quarters after they reported June went down.
Berkshire Hathaway reduced their position in Apple, even though Apple is having a rough day. Do you still see it outperforming other stocks?
Yes, and I've explained why. I think you're going to get an iPhone upgrade cycle, and I think it'll do well. Berkshire might be selling, but it became a very big portion of their portfolio. I have no idea why they're selling it. And quite honestly, it doesn't matter to me. You know, obviously Warren Buffett's one of the world's greatest investors. He's selling it for whatever reason, no idea why. But in technology, he has more of a mixed record. Obviously, he owned a lot of IBM back in the day. That did not work out very well. Apple obviously has worked out well, but it's also become a huge percentage of his portfolio. So for me, I look at Apple over the last several years. The stock has gone up, but it hasn't gone up because of revenue growth. As I said, the revenue growth has been 2% per year for the last 3 years, which is horrible relative to all other technology big cap stocks. And so maybe he got tired of that and doesn't believe there will be an upgrade cycle, but that's what makes markets. Some people like stocks at certain levels, others don't. And over time, we figure out who's right and who's wrong.
Does that mean Apple is better than NVIDIA?
Over the near term, yes.
We are seeing some capital moving away from tech stock to other sectors that haven't seen as much of a run-up. How do you view this trend, and what impact do you think it will have on overall market dynamics?
Well, as of Tuesday, if you look at the market, since the peak in stocks back, I think on July 16th, so that's when the S&P 500 peaked. As of the close on Tuesday, the S&P was down about 2% from those levels. The Magnificent Seven stocks were down about 9% from those levels. But the equal weighted S&P was actually up 1%. So the other 493 stocks outside of the Magnificent Seven in the S&P 500 are actually doing well. And that's a good sign. And as I said earlier, for us, the stocks that we're very focused on between now and year end are companies that benefit from rate cuts. And so that would be names such as consumer staples or utilities or telecom services, where their dividend yields in particular look a lot better if 10-year Treasury yields driven by Fed funds rates are much lower. And so you have seen those sectors start to outperform as it's become more clear that the Fed will cut rates. And for a lot of these tech stocks, as I said earlier, even about Apple, the stocks have gone up a lot, not necessarily because the revenue or earnings growth has been fantastic, but because the multiples have gone up so much. If you look at the S&P 500, it's trading at about 23 times. And for Apple, their PE ratio is about 32 times. So most of these tech stocks are not that inexpensive, but a lot of these other 493 names in the S&P 500 actually are at pretty good valuations because everybody wants to own 7 stocks, and that's left the other 493 at much cheaper valuations, even though in many cases the growth isn't that bad.
Many investors are currently very concerned about market downturn and volatility. Given the current market condition, how should we approach the second half of this year?
I think the main thing is don't focus on just 7 stocks, because much like you saw in 2022, when the Magnificent Seven stocks went down 46% during 2022, that's a very dangerous position if you have all of your money invested in just 7 stocks or just a couple of stocks. I think in this environment where you know growth is slowing, you know China in particular, which is the second most important outside of the US, is weak. you need to be more defensive, especially because valuations, especially for tech stocks, are so high. And so I think you need to think more about maybe I need a broad index. If I still want to participate in the stock market, I should be in 500 stocks, not Magnificent Seven stocks. And that way you're more protected if I'm wrong, and there is a recession this year, or if the AI trade is more problematic than what even I think. Because remember, we had a great build out of the internet from late 1994 through 2000. And then NASDAQ went down 78% over 2.5 years. And it was painful, it was punishing. And that was all driven by this huge build out that then had to be absorbed. And so I think investors should consider themselves lucky that we've had so much monetary stimulus from central banks around the globe. We've had a lot of money put in by governments around the globe following COVID. And so that has driven up valuations globally. And at this point, you want to protect, especially if you're an older investor, what you earned over your lifetime. And so I think if you want to stay in the stock market, you should be thinking about being more and diversified as opposed to owning just a handful of stocks.
Thank you for the interview. I look forward to hearing more of your insight next time.
Thank you.